earnings season is kicking off this week. This is going to be the most important earnings season, golly, man, that I can remember. And it's interesting because analysts, they typically, I don't know if people know this, the analysts typically cut earnings expectations right before earnings. And it kind of seems to be this like game, because they all like companies typically end up beating earnings on average. So I don't know, they lower expectations so that they can get beat. But they particularly really kind of didn't like the financial sector with the low M&A activity that they've been having, and with interest rates being cut. It's really a big shock that BlackRock, JP Morgan, and Wells Fargo all beat the pants off earnings this morning and are all really, really up. With the PE ratio of the S&P 500 at 2787, we're in some pretty high territory. If earnings continues like this, that'll bring down that PE ratio in line with where it's a more normal place. But there's a lot of pressure on companies to beat earnings. If they don't, we're definitely going to see a bit of a sell-off.
Mm-hmm.
And so last time you were on, we talked about the short squeeze, so are we going? Obviously this isn't a short squeeze. This is earnings play. So how do you go ahead and get yourself into the mindset of taking advantage of that? And then AJ, how would you apply what you do and some of the things we've talked in the past to what Dan is looking at in these next upcoming earnings sessions or calls?
Yep.
Yeah, well, AJ mentioned earlier about how important this earnings season is. So like all eyes are on it. And when that's the case, it sets up my earnings trading system really, really nicely. We're going to talk extensively about it in the webinar next Wednesday night. Mm-hmm. But I'll kind of steal my own thunder a little bit and let you know a little bit of what we're going to talk about. Basically, when earnings are imminent, as we lead up to earnings, what tends to happen is people buy up the short-term options, especially the ones that expire like right after earnings is announced, later that week. And so when that happens, it kind of puts out of proportion what we call the volatility term structure, which is just a super fancy word for saying the short-term options get more expensive than usual, while the back-term options don't get that much more expensive. So in some circumstances, and not all, but in some circumstances, it sets us up really, really nicely for what we call time spreads or calendar spreads, so we can sell those overpriced options and buy those underpriced options. And man, it can be really powerful. There's a lot of nuance to it. That's why we're having a whole webinar next week about it. But you'll learn all about that next week.